Welcome back to the deep dive. This is where we really dig into the complex stuff, the research, the theories, the market shifts, and, try to make it all clear and useful for you. Today, we're tackling something that honestly feels a bit upside down. For years, Bitcoin meant crazy volatility, right? Those huge spikes, the big crashes. But now we're diving into this pretty bold idea, mainly from Michael Saylor, but backed by a lot of data, that Bitcoin is actually getting, well, boring.
Uh-huh.
And the twist is that's supposed to be incredibly bullish.
That's exactly it. And our mission today really is to put that idea under the microscope. We're looking at the interviews, the on-chain data, the reports on institutional money flow, everything we can find.
Right.
We need to figure out, is this lower volatility, this institutional rush, is it really the sign of maturity? Or does it maybe dilute what Bitcoin was originally all about, that transformative potential?
Yeah, and if you're in this space, you really need to understand this shift. It affects everything going forward. Are we still in that kind of Wild West phase? Or are we watching Bitcoin become, I don't know, a serious global digital reserve asset? Because that changes the game entirely. Okay, so before we jump straight into Saylor's thesis and all the evidence, just a quick point about how we keep this analysis going. If you find these deep dives valuable, hitting that like button, subscribing, maybe clicking the notification bell, it genuinely helps us out.
It really does.
It boosts our visibility, helps the channel grow, and basically lets us keep making this kind of detailed content for you. Your engagement, well, it fuels these sessions.
Absolutely. Okay, so let's get to it. This paradox. Boring is bullish.
Okay, so the big idea from our sources, mainly Saylor, but it's showing up in institutional reports too, is that institutions coming in makes Bitcoin boring. Which, like I said, sounds almost wrong for Bitcoin. What exactly do they mean by boring here? Is it just flat?
Yeah, it's key to understand. Boring isn't about zero growth or stagnation. It's really a technical term. It means less wild price swings, more stability, more predictability, especially on a risk-adjusted basis.
Ah, okay.
So when Saylor and others say boring, they're talking about volatility compression. Historically, Bitcoin's 30-day volatility could just go nuts, right? Hitting 150%, leading to those massive 70, 80% drops we saw in, say, 2018 or 2022.
Yeah, gut-wrenching stuff.
Exactly. So the boring phase means smoothing those out. The idea is Bitcoin starts behaving maybe more like a high-growth tech stock, or ideally, eventually, like gold. You're looking at drawdowns maybe in the 20-30% range, not 80%. And that is something traditional finance can actually handle.
Right, because if you're managing billions for a pension fund or something, you just can't stomach an 80% drop. It's not just scary, it's probably against your mandate, right?
Precisely. That extreme volatility is a huge wall. It keeps institutions out. So when Bitcoin becomes less volatile, gets boring, it suddenly opens itself up to a massively larger pool of capital.
Yeah.
We're talking moving from maybe hundreds of billions in speculative money to potentially tens of trillions in global institutional money, maybe even central banks down the line. Stability is literally the key that unlocks those trillions.
And that's the paradox, isn't it? The very thing that made Bitcoin famous, the crazy price action,
Yeah.
was also limiting its potential reach. By shedding that, it stops being just this wild bet and starts looking more like a serious, almost necessary portfolio component, like a hedge.
Exactly. The sources keep bringing up parallels like gold or even long-term treasuries. They don't make exciting headlines every day, but they provide stability and trust over long periods. That's the transition they see for Bitcoin, from a volatile trading thing to, well, a trusted piece of financial infrastructure.
Which really forces a question on anyone listening, doesn't it? Looking ahead, what do you actually want Bitcoin to be? Do you prefer the wild ride of 2017 with the potential for huge gains but also huge losses? Or do you prefer this idea of a steadier, safer digital gold that might grow more slowly but reliably? The sources seem to say you can't really have both anymore.
And the core argument is this boring phase, if it happens, is actually the most bullish phase Bitcoin has ever seen.
Yeah.
Because the conversation shifts. It stops being, will Bitcoin even survive? And becomes, okay, how much Bitcoin should we allocate?
Yeah.
Boredom signals maturity, it signals trust from the big players, and it signals adoption on a massive global scale. It's moving beyond just speculation.
Okay, let's dig into the mechanics then. If
Yeah.
stability is the magnet pulling institutions in, what are the actual forces doing the pulling? It has to be more than just, a few companies buying some Bitcoin.
Oh, absolutely. It's a much bigger, more systemic shift. We're talking about institutions with balance sheets that make some countries look small. And the source material points to three main types of players who aren't just buying, they're actively pulling supply off the market for the long haul.
Okay, who are they?
Well, first, and maybe most obviously right now, you've got the spot ETFs. Think BlackRock's iShares, Bitcoin Trust, Fidelity's, all of those. These have been game changers.
How so, specifically?
They basically solve two huge headaches for traditional finance. Custody, the risk of holding the actual keys, is handled by regulated players and access. Institutions can now buy Bitcoin exposure through a simple ticker symbol, right, in their existing brokerage accounts.
Yeah, no need for wallets or complex security setups, just buy the ETF.
Exactly. It massively reduces the friction. And these ETFs, they act like giant vacuum cleaners for Bitcoin, driven by daily inflows from wealth managers, pension funds, advisors, putting it into long-term allocations.
Yeah.
This isn't short-term trading. It's structural, sticky demand.
Okay, so ETFs are number one. What's next?
Second, you have corporate treasuries. And the prime example here, obviously, is MicroStrategy. They've accumulated, what, over $15 billion worth? And crucially, they're framing it not as a trade, but as a core part of their treasury reserve strategy.
Right, which is totally different from how most companies manage cash, usually just holding short-term bonds or something super safe and low yield.
It's a radical shift. They see Bitcoin as a long-term inflation hedge, a way to preserve capital against, currency debasement. And their stated plan is basically to hold it indefinitely, like for 100 years.
Wow.
Yeah. So this isn't market timing. It's strategic accumulation.
Yeah.
They're taking billions worth of Bitcoin out of circulation effectively forever. That shrinks the available float.
Okay, so ETFs, corporate treasuries. What's the third force?
The third one is maybe more potential than reality right now, but the sources mention it. Governments and potentially sovereign wealth funds. Now, this is further down the road, probably. But the stability and regulatory clarity brought by the ETFs and corporate adoption, those are the absolute prerequisites for this level of player to even consider it.
Because a sovereign fund can't really explain a 75% crypto crash to its citizens or board.
Exactly. They need that stability first. But if it comes, that's the ultimate layer of capital.
So all these big players, ETFs, companies like MicroStrategy, maybe governments, eventually they all contribute to this idea the sources call the liquidity shift. Can you explain that? How does this accumulation change the market's, physics?
Yeah, the physics analogy is pretty good, actually. It's about where the dominant liquidity is coming from and where it's going. Historically, Bitcoin was dominated by fast money. Meaning retail speculators, maybe hedge funds, using leverage, trading on technicals, often driven by emotion, FOMO, FUD.
Yeah.
The drill, quick in, quick out. Now, the shift is towards slow money. This is institutional capital. It's patient. It operates under strict mandates, often with very long time horizons. When a pension fund buys Bitcoin via an ETF, they aren't planning to sell it next week. They're locking it away, often in cold storage, for years, maybe decades.
So the coins literally leave the active market.
Pretty much. They move off exchanges where they could be easily traded and into these institutional vaults or long-term holdings. This creates a supply shock. The amount of Bitcoin readily available to buy keeps shrinking.
So even if demand just stays steady, the price becomes more stable because there's less freely floating supply to cause wild swings.
That's the idea. It underpins that fundamental change in how Bitcoin is viewed. It stops being seen primarily as this risky gamble where the main point is the price volatility itself.
Right.
And it starts being seen as a genuine reserve asset. Its utility becomes long-term capital preservation, a hedge against broader economic uncertainty.
That makes the analogy with the internet's trajectory really click. The sources mention this. How the early internet was that chaotic Wild West.
Yeah, exactly. Think late 90s .com bubble. The underlying tech, TCP/IP, was fascinating, sure, but it was seen as a high-risk venture, super volatile.
Right. Pets.com and all that.
But once adoption hit critical mass, once everyone had email, businesses needed websites, e-commerce took off, the underlying internet infrastructure just sort of settled down. It became essential plumbing. It became boring. Nobody wakes up thinking, will the internet protocols work today? You just assume they will.
So the argument is Bitcoin is going through that same process now, becoming part of the essential financial plumbing.
That's Saylor's core thesis, yeah. The global financial system is starting to bake Bitcoin in, moving it from this fringe experiment to just necessary, boring infrastructure. And what's really interesting about this shift towards stability is how it affects different people in the market. It's not necessarily good news for everyone, or at least it changes the game. It creates sort of winners and losers depending on what you're trying to achieve.
Okay, let's start with maybe the group that feels the change most acutely, the retail traders. If volatility dries up, what happens to the day traders, the swing traders, who lived off those big moves?
Well, the sources suggest that the era of relatively easy 100x gains just by buying and holding BTC through those crazy cycles.
Mhm.
That's probably winding down, or at least it'll be much harder
Why?
because those traders thrived on the inefficiency, the massive price swings, often amplified by leverage. If institutional buying smooths out those peaks and troughs, those opportunities for quick, outsized returns within Bitcoin itself just diminish.
So the potential gains become smaller, more like traditional assets.
Yeah, the returns profile starts to look more annualized, maybe closer to what you'd expect from equities or other risk assets, rather than those lottery ticket type parabolic runs. The entry points aren't as dramatic, the exits aren't as explosive.
Okay, so the fast money looking for those moonshots might have to look elsewhere. We'll get to where later. But what about the other side? The long-term investors. This sounds like good news for them.
Oh, overwhelmingly positive, according to the sources. The big benefit is the reduced downside risk. We talked about those scary 80% drawdowns.
Right.
If those become a thing of the past, or at least much rarer and shallower, Bitcoin suddenly becomes way more attractive for traditional portfolio building. Think about the classic 60-40 stock bond portfolio.
Mm-hmm.
If you can add a small allocation to Bitcoin, say 1%, 2%, 5%, without it threatening to blow up the entire portfolio during a downturn, then suddenly huge pools of capital can start considering it. We're talking trillions managed by conservative allocators. That stability is the key.
Okay, but this leads to a bit of a philosophical challenge, doesn't it? The sources touch on this. Institutions bring stability, which is good, but don't they also bring centralization? More specifically, centralization of influence. Are we trading away the original decentralized dream for stability?
That's the heart of the trade-off, yeah.
Right.
And it's maybe the most important nuance here. Bitcoin was built on this idea of peer-to-peer, decentralized money, no intermediaries, right?
Right.
But if a huge chunk of the circulating supply, let's say 5%, 10%, maybe more, eventually ends up concentrated in the vaults of a few large regulated entities, mostly US-based like BlackRock, Fidelity, maybe MicroStrategy, well, then market influence does become more centralized.
And centralized influence means centralized risk, doesn't it? Like regulatory risk.
Exactly. You gain price stability maybe,
Yeah.
but you introduce a new kind of risk,
Yeah.
systemic regulatory risk. What if a major government decides to force those big custodians or ETF issuers to sell or freeze assets or impose strict controls? The impact could be huge.
So we swap chaotic market volatility for potentially more predictable, but maybe more dangerous, regulatory volatility.
That's one way to look at it. It's the potential cost of maturity. You get integrated into the system, but you also become subject to the rules and pressures of that system.
It really forces you, as an observer or investor, to wrestle with that question. Is this institutional adoption ultimately strengthening Bitcoin's mission by ensuring it survives and gets used globally? Or is it kind of watering it down, making it just another asset within the traditional system it aimed to disrupt? The sources seem to present it as an almost unavoidable choice you have to make for Bitcoin to scale.
And it's important to note the centralization they talk about is mostly at the custody layer, who holds the coins. Not necessarily the protocol layer. The network itself remains decentralized.
Ah,
But the economic power, the influence over price and market structure, that gets concentrated. And the bet the big institutions are making is that the stability and legitimacy gained from this are worth that trade-off. That's what gets Bitcoin accepted by the mainstream.
okay, so let's follow the logic. If Bitcoin does become this more stable, boring asset and those massive speculative gains become harder to find there, where does all that risk-seeking capital go, that fast money we talked about? It has to go somewhere, right?
Yeah, it doesn't just disappear. It'll chase the next big opportunity. And the sources seem to sketch out how the whole digital asset market might restructure itself around this.
They do. The picture that emerges is Bitcoin solidifying its role as the base layer, the sort of low-risk anchor for the whole digital asset world. It's the main store of value, the primary collateral, the asset institutions trust first. It becomes the digital bedrock.
Okay, the stable foundation. Exactly.
Yeah.
But that stability creates a kind of vacuum for the higher risk, higher reward plays. And that vacuum, the sources suggest, gets filled by altcoins and layer 2 solutions, L2s. They become the new risk-on playground.
Ah, so the speculation just moves down the chain?
Precisely. If you're looking for those potentially explosive returns, the innovation, the volatility that characterized Bitcoin's early days, you're now more likely to find it in other ecosystems. The capital naturally flows there.
Which ecosystems specifically?
Well, the sources mention established players like Ethereum and Solana, obviously, but also the broader DeFi space, decentralized finance, and things like NFTs, maybe new layer 1s we haven't even seen yet. These areas offer the tech bets, the higher potential growth, but also the higher risk and volatility that institutional money is actively trying to avoid by sticking with Bitcoin.
So the speculative energy kind of shifts, becomes more compartmentalized within the crypto market itself.
Absolutely. You end up with a more mature market structure, actually. It starts to mirror traditional finance in a way. You have Bitcoin acting like your digital gold or maybe your stable government bonds, the reserve asset. Then you have the altcoin ecosystem acting more like your venture capital, your emerging markets, your high-growth tech sector. Different assets serving different needs and risk appetites.
That actually makes a lot of sense. It suggests the whole industry is growing up, developing distinct layers.
Right. And this separation could be healthy. Institutions can get comfortable entering the space via Bitcoin, bringing in huge amounts of capital and legitimacy. Meanwhile, the innovation and the hunt for massive returns can continue buzzing away in the altcoin and Web3 space. It allows for different functions, different risk profiles, all within the same broad digital asset class. The industry stops being just one thing and becomes a more sophisticated, multi-layered system.
Okay, this all sounds logical. The thesis holds together. But let's pivot to the proof. What actual evidence, what data points do the sources provide to show this isn't just theory? That Bitcoin is already maturing, already getting more boring in that technical sense.
Yeah, good question. We need to move beyond just the narrative. And the sources do point to several concrete metrics and historical parallels that support this idea of increasing stability and serious accumulation. We're talking about trends visible in on-chain data, things analysts at places like Glassnode or ARK Invest often track.
Okay, where do we start?
Well, maybe first with the big historical parallel, gold's trajectory. This is really foundational to the whole boring is bullish idea. People think of gold as this super stable hedge now, right?
Mm-hmm. The classic safe haven.
But it wasn't always like that. Back in the 19th century, early 20th, during the gold standard era, gold actually had significant volatility. Price swings were driven by new mine discoveries, industrial demand, trade imbalances. It only became the stable, boring asset we know today after decades of being adopted by central banks, integrated into the global monetary system. Its stability is a result of mass adoption and institutionalization over a very long time.
So the argument is Bitcoin's just on a faster track following that same path.
That's the parallel they draw, yes. It's
Wow.
maturing into that reserve asset role.
Okay, what about more recent history? Didn't the sources mention Tesla's experiment with holding Bitcoin?
They did. That was sort of an early, maybe slightly chaotic test case. Tesla buying Bitcoin, then selling some. It showed a couple of things. First, just how much impact a single large corporation could have on sentiment back then.
Right, the price moved hugely on their news.
Exactly. And second, it kind of highlighted the need for the stability we're talking about now. If one company's actions could cause such waves, imagine the stabilizing effect of dozens of regulated ETFs bringing in steady, continuous flows every single day. It's a different order of magnitude.
Okay, so history provides context. What about the hard data now? Let's start with the most direct measure, the volatility index itself. Is it actually going down?
Yes, the data shows a clear long-term trend. If you look at Bitcoin's realized volatility, say over 90 days, the baseline is gradually compressing. Of course, you still get spikes, especially around major events, but the overall trend is downward. Those extreme peaks above, say, 100% or 150% volatility are becoming less frequent. The range seems to be settling more often in the, let's say, 40% to 60% band. That is the quantitative measure of the asset becoming less wild, more boring. The institutional money seems to be acting like ballast on a ship, dampening the waves.
Okay, so volatility is trending down. What about who's holding the coins? You mentioned slow money earlier. Can we see that on-chain?
Absolutely. This is where the on-chain data gets really telling. Metrics tracking coins held for 1 year or longer, often called long-term holder supply, have been hitting all-time highs, or near ATHs, persistently.
Meaning people are buying and just sitting on it.
Exactly. It shows the dominant behavior in the market right now isn't frantic trading, it's patient accumulation. These long-term holders, which increasingly include institutions in the ETFs, they aren't easily shaken out by price dips or bad news. They're playing a much longer game. They're treating Bitcoin like savings, not a trading chip.
And if they're holding, that must affect the available supply, right? Leading to that supply shock idea.
Precisely. It connects directly. If coins are being locked away by long-term holders, they have to be coming from somewhere. And the data confirms they're coming off the exchanges. The metric tracking the amount of Bitcoin sitting on exchange wallets has been hitting multi-year lows.
So the for-sale inventory is shrinking?
Effectively, yes. Coins are moving from readily available trading venues into cold storage or private wallets. Less supply available means even moderate, steady buying, like from the ETFs, has a bigger impact on price. But because that demand is more consistent and less speculative, it tends to stabilize the price floor rather than causing those crazy vertical spikes we used to see.
Okay, and you mentioned the ETFs. Is there data showing their direct impact on stability, the ETF correlation?
Yeah, since the launch of the big US spot ETFs, analysts have tracked the correlation between the daily net flows into those ETFs and Bitcoin's price action. And there's generally been a measurable positive correlation.
Meaning inflows tend to support the price.
Yes, and perhaps more importantly, they seem to dampen downside volatility. When you have billions flowing in consistently over months, it acts as a significant buffer against sharp sell-offs. It's concrete evidence of that institutional stabilizing effect Saylor talks about.
Got it. One last metric, the BTC dominance chart. How does Bitcoin's market share relative to altcoins fit into this institutional story?
BTC dominance, Bitcoin's percentage of the total crypto market cap, is often seen as a kind of risk gauge for the whole sector. When big traditional money enters the crypto space, where does it usually go first?
Bitcoin. It's the biggest, oldest, most recognized name.
Exactly. It's perceived as the safest entry point. So when you see BTC dominance rising, it often means institutions are allocating heavily to Bitcoin, sometimes even rotating out of riskier altcoins into Bitcoin. It reflects a risk-off move within the digital asset world itself.
So higher dominance can signal institutional preference for the stability and security of Bitcoin over the potential higher returns, but higher risk of alts.
That's generally the interpretation, yes. It reinforces Bitcoin's role as that base layer, the primary destination for large conservative capital entering the space. It's the institutional seal of approval, in a way. Hashtag tag tag outro. So if we try to pull all this together, synthesize what we've dug into across the interviews, the data, the analysis, the core takeaway really seems to be this. Bitcoin becoming boring isn't some kind of failure. It's not the end of innovation.
Right.
According to this thesis, it's actually the ultimate sign of success. It signals that the market is maturing, that legacy finance trusts it enough to allocate serious capital, and that Bitcoin is achieving that critical scale needed to be a real global asset.
Yeah, and for you listening, the practical synthesis seems to be, okay, maybe those dreams of quick, easy 100x gains in Bitcoin itself need to be adjusted. That kind of high-risk, high-reward seeking might need to shift towards the altcoin space, the DeFi world, where innovation is maybe faster and risk is higher.
But what Bitcoin potentially gains in return for losing that explosive edge is profound. Stability, security, and ultimately cementing its place as a legitimate, maybe even necessary, global reserve asset. It trades the flashiness for reliability. It feels like the Wild West saloon doors are closing and the doors to the, I don't know, the digital reserve bank are swinging open.
That's a good way to put it. Which leaves us with one last thought to chew on, maybe a provocative one. If this thesis plays out, if institutional adoption really does smooth out Bitcoin's volatility, makes it predictable, makes it securely held by regulated players, does that finally create the conditions, the trust, the regulatory comfort for the ultimate players, the central banks, the sovereign wealth funds, to actually start considering holding Bitcoin as part of their official reserves?
Wow. Yeah, if that happens. Well, that changes global finance on a whole different level. We'll leave you with that thought. Thanks for diving deep with us again.
Thanks, everyone.
We'll catch you on the next one.